Well, the parade of layoffs, especially in tech companies, continues. Today, Salesforce announced that it will lay off employees. Salesforce is the largest employer in San Francisco. And San Francisco is being hit especially hard by tech layoffs. But, with pretty much all tech companies cutting jobs in varying amounts, I suppose that it should not come as a surprise that Salesforce is also cutting positions. This video continues our coverage of the wave of layoffs sweeping the United States. So, what does this mean for San Francisco? What does it mean for big tech companies? What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Salesforce has laid off at least 90 employees according to a statement by the company. All of this comes as tech stocks deal with the ongoing effects of a weakening macroeconomic environment. If you follow this channel, you already know the underlying economic forces impacting tech companies. Inflation is raging in most countries of the world. Central banks all over the world are raising interest rates in order to fight inflation. Wall Street analysts are cracking down on unprofitable tech companies that basically are not growing anymore. So layoffs are sweeping the United States. As a result, consumers are not so confident in their job security. So they are pulling back on spending. Because of that, corporate marketers are cutting their ad spending. And ad spending is the lifeblood of tech companies. So, tech companies of all sizes are having layoffs. And on the narrative goes. Shares in Salesforce were down 1.3% at the time of the layoff announcement. But more importantly, Salesforce stock is down 44% since the start of the year. This is the company's second layoff in 2022. However, the first layoff was small. Salesforce also implemented a new hiring freeze which is in effect through January 2023. Details about the layoff were not immediately available. But, it seems that at least people but might be mostly contract workers and maybe not too many full-time employees. Salesforce has more than 73,000 workers. And, although layoffs are never a good thing, 90 workers from a total of 73,000 is a fairly small fraction. But, as you probably learned, big tech companies are shying away from actually announcing layoffs. They want to avoid scaring shareholders and damaging their brands. These days, there is some fear among Wall Street investors the growth prospects for many big tech companies have fundamentally. Salesforce did not make a spokesperson available to comment on how many employees were affected. Salesforce has had an on-again off-again hiring freeze. The hiring freeze was on in May. Then, about a month ago, it was off. And now, it is back on. Salesforce corporate culture is said to be like the Hawaiian tradition of the ohana. Ohana basically means a type of extended family that is not necessarily connected by blood, but rather by shared experience and sense of community. A Salesforce representative did not say whether the company still considers the terminated contractors part of its ohana. Salesforce also had a layoff in August 2020. Coincidentally, the layoffs were announced immediately following a report of record quarterly revenue. This latest round of layoffs comes at an interesting time. Wall Street analysts have questioned Salesforce over its future growth potential. Salesforce recently promised Wall Street analysts a goal of hitting 25% operating margin by 2026. So, if growth has stalled, then more job cuts will be in the cards. And, that seems to be something of a theme running through the tech patch these days. For years, tech companies of all sizes achieved valuations based on high future growth prospects. But, in 2022, it is coming clear that growth is slowing or even reversing for many tech companies. And, for a number of so-called tech unicorns, the prospect of profitability seems as though it might never come about. And, actually, I think that this is probably the main narrative that Wall Street analysts are discussing regarding tech companies. We are on the threshold of an era of financialization of big tech and tech unicorns. As you already know, Google and Meta platforms reported decidedly disappointing Q2 earnings. Not surprisingly, both companies revised or revoked forward guidance. Google was still profitable and growing. But top and bottom lines were disappointing. Meta has posted shrinking revenue for 2 quarters and maybe a third quarter as well. Both companies have hinted at layoffs, but not actually made detailed announcements. Meta Platforms management promised cost cuts, hiring freezes and ruthless prioritization. Meta has begun quietly pushing out a significant number of employees. The company has restructured departments and given employees 30 days to find a new job within the company. This enables the company to cut a lot of positions without having to issue pink slips en masse. Analysts expect these reductions to be a precursor to deeper cuts. Meta is trying to cut costs by at least 15% by the end of the year. These days, employees with good reputations and strong performance reviews are being routinely fired. Meta has about 83,000 employees, which is 32% higher than at this time last year. Google has 174,000 employees, which is 20% higher than this time last year. Layoffs at big tech companies are big news because the biggest tech companies went on a veritable hiring spree throughout the pandemic. Shares in Meta Platforms are down by over 50% so far this year. And the market capitalization of Meta has fallen by over $685 billion since its all-time peak in September 2021. The market capitalization of Google is down 27% over the past 122 months. Google chief executive Sundar Pichai said, Google would slow hiring for the rest of the year and employees should be more entrepreneurial. Speaking at the Vox Code conference, Mr. Pichai said that Google needs to be 20% more productive. But not all big tech companies are adopting the stealth layoff approach like Google and Meta. Snap has publicly announced layoffs of 20% of its employees. This comes after Snap grew its headcount by 65% within the past year and a half. Google, Meta, and Snap are probably the most notable of the companies reducing headcount. But there are many others. Real estate platform company Compass has just announced that it completed its second round of layoffs. Compass has yet to become profitable as company. As a result, unprofitable tech companies' shares are getting punished. It seems that the day of reckoning for tech unicorns has arrived. And all companies are forced to either be profitable, find a merge partner, or die. The window for initial public offerings is effectively closed. That is why some Wall Street investment bankers are predicting a wave of tech mergers later this year. Twilio, another unprofitable tech company, is pretty much in the same boat as Compass. Last week, Twilio announced the layoff of 11% of its employees and a broad financial restructuring. It comes amid a broad macroeconomic downturn in the United States. Last month, Meta Platforms CEO Mark Zuckerberg told employees that the company plans to reduce its hiring target for engineers from 10,000 to between 6,000 to 7,000 amid the market downturn. Realistically, there are probably a bunch of people at the company who shouldn't be here, Zuckerberg said. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.